little dribs and flows, but you're not going to see 19% or some of this other stuff that we just be seeing lately. Unless the government just goes nuts and starts printing money again, which who knows, maybe they do, but I think we're going to start to see more of a softening and leveling off.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Chris, welcome to the show.
Matt, thanks for having me. How are you doing today?
I am fantastic. Although here in Nashville, it's late October or late November. Gosh, I don't even know what month it is. It's starting to get a little cold here. Starting to get a little chilly.
Yeah, so I'm just outside of Washington, D.C. Like a week and a half ago, it was like in the 70s. And then all of a sudden, I just woke up one morning. It was like 50 degrees or 40. Or actually, it was 33 degrees one morning. But typically right now, it's about 50. But we're in this season now, which I think you're probably in too, where, you get some rain or light rain in the evening. So you wake up in the morning, it's just wet, raw,
freezing,
cold. Yep. It's like, icky outside.
Yep. Well, we got to change the tone of this conversation. Tell me, what's your favorite ice cream?
So chocolate chip. So this is simple chocolate chip. And I also, though, a close second, or probably 1A and 1B, would be peanut butter cup.
Okay.
So
I like it. It. Now you're in Arlington, right?
Alexandria, just south.
Okay. Yeah. Gotcha. If I find myself in the Alexandria area, do you have a favorite ice cream shop?
I don't actually. There's not a lot of. That's one thing around here. There's not really really good ice cream shops. I mean, honestly, and this is going to sound cliche, but like a Cold Stone is probably the best ice cream shop. We have some really good coffee shops and stuff, but ice cream, I don't know if it's because of weather or whatnot, but it's really not that great for ice cream in the area.
Yeah, well, you're too fit for that anyways, right?
I like to think so. I mean, I grew up in Massachusetts, which is home to Friendly's ice cream, if you're familiar with Friendly's, which is more of a Northeast thing. And they used to have their own restaurants as well, where it was more like a diner that you could get there, the ice cream and stuff. And I was a big fan of Friendly's growing up.
Gotcha. I'll have to put that on my list next time I'm up in the Northeast area. But for our listeners who might not be familiar with you, tell our listeners, what's the scoop? What do you do today?
Yeah, today I run a real estate fund focused on defaulted mortgages. So on the residential side. So I got into that through real estate as my full-time job. And then as I started growing my own investments, left my W-2, went out on my own, got a business partner, Lauren, to launch the fund, which we've had now for 2+ years. And one unique feature about it is that it's open to both accredited and non-accredited. So little unique twist, because most people are used to, plopping down a big chunk of money into a accredited investor fund. And we tried to use that blue ocean strategy of keeping it open to the masses.
Is your non-accredited, is that a Reg A fund? Yep. Can you talk to us a little bit about, so most people are probably familiar with like 506B and 506C. They might not know what a Reg A is. Can you talk a little bit about what a Reg A fund is?
Yeah, so a Regulation A fund, it's very different from a 506B or C, whereas you actually have to get qualified by the SEC. So we had to submit a PPM to the SEC, review their comments, make sure it responds, because we're soliciting to non-accredited investors. So when you can solicit or advertise to people who are non-accredited, it's very specific on what you can and cannot do. So that process, for us took about 3 to 4 months to get that qualification, but there's a lot more hurdles involved where you have additional costs to set it up. We have to submit SEC audited financials. So the way I look at financial statements is there's your financial statements that somebody can do. Then there's audited financials, which is like a CPA does. And then there's SEC audited financials, which, man, it's painful. Yeah. But what it does do is allows for some of that transparency and allows for investors to have everything that's available has to be public. With the financials and what the offering is. So there's no, swiping of oh, we don't have a PPM or we changed a PPM. Like we can't do any of that stuff with a Regulation A offering.
Gotcha. So why did you decide to go that route? Because that might be, again, it's kind of a little niche inside of this space. So why did you decide to go that route?
Yeah, great question. And really, when we were looking at this offering, so in a mortgage note fund, when you look at a capital stack, there's no debt. And so the investors have, the investors, whether they're issued a bond or shares, they're at the bottom of the capital stack. And because of that, when there's no outside debt, what debt, I view debt as it amplifies things. So it can either amplify your returns or amplify your losses. Now, back in 2022, what was everyone investing in at that point in time? Multifamily deals offering 18, 20, 30%. And all the 506C investors were flocking to multifamily, flocking to self-storage, or, name the oil and gas, whatever the case may be. And if I'm sitting here going, hey guys, I can get you 8 to 10%, back then everyone's looking at you like, okay, sure. Like that's getting a car that goes 30 miles an hour. Because a lot of investors, one of the challenges with people, when you, as an investment, you just can't look at the number of what they think the return is. You have to look at the risk profile. And by, opening it up to both accredited and non-accredited investors, most 506, well, all 506Cs never chase that non-accredited investor. So gives us the ability to have both, which today we have 700 investors. So, we've been able to grow from both sides of accredited and non-accredited.
Yeah, I do think that the number one thing I see with new investors is they're chasing the number, right?
Yep.
There's a ton of people that I've talked to that have come through one form or another through our funnel, and they're like, "Oh, you guys are only paying 8%. Well, Chris over here is paying 9%, so I'm gonna go there." And they never take a step back and look through, well, Chris might be levered up 120%, or he's got a bunch of properties in Austin, Texas, which we were talking about before. Love Austin as a city, very oversupplied market for at least the next 5 to 10 years. So it's important that you understand not only what the number is, but how you're getting to that number and the assumptions they're making.
Yeah, great feedback there. And also understand what's your tax consequences on this too, because some funds have better tax ramifications. So your 9% could actually be worse than my 8% because you might be taxed at a much higher rate depending on how it's structured. But a case in point of that is a perfect case study where there was a note fund recently that got themselves allegedly in trouble because they paused distributions and there's a lot going on. And they were offering 10 to 12%, and they bumped it up to 17% plus a kicker. And when they bumped it up to 17%, because there's a Facebook group put together and people are asking, when did you invest? 90% of the people invested after they bumped the returns up to 17%. And unfortunately, this fund, actually doesn't invest in real estate, it invests in other things. And then there's another company that is out there that is now under SEC investigation. They've shut them down, that they're offering 10% per quarter. Okay.
Wow.
I'm going to rephrase that 10% per quarter. And they raised $300 million. And we had people come to us, and I'm sitting on a webinar and someone asked a question, well, you're paying 10% per year. I'm getting 10% per quarter. And I'm sitting there like, well, good for you, but it ain't real. I mean, there's no company on the planet that can historically give you 10% per quarter, for a period of time, and also make money for themselves. And they're also paying people commissions of 16% too. So 56%, returns before they took a dollar. And come to find out, the guy, bought a boat, bought a net jet, bought, $50,000 at Cavalier games, or, all the different things where complete Ponzi scheme where you're just recycling the money. And, people are like, oh, well, this is what they said you get. If it's too good to be true, it is. Like if you and I are both having the same fund and offering 8, 9, 10, okay, that's, depends on, expertise or length of hold, or there's different strategies. But if everyone's at 8 to 10 and somebody's at 15, 16, 17, I'm sorry, but they aren't good enough to really get that much better of a return compared to everybody else.
Right. Yeah. My dad taught me that business lesson very early in my life. He was a steel building contractor. And basically, he
Oh,
sent a
yeah.
quote to somebody for like 50 grand. I forgot the number.
Yep.
And somebody else came in at like 17. And the
Yeah.
guy called him and said, "Hey, I'm going to go with this other one." He just goes, "There's no way we're that far off. It's a pretty
Yeah.
competitive world out here. If
Yeah.
we're that far off, something else is wrong."
Yeah. I spent 20 years in the project management, and yeah, we put out bids and stuff like that. And, you'd see three, quotes of, 2.9, 3 million, 3.1, and somebody comes at 2.2. Your immediate thing is guy with 2.2, but he's missing something.
Right.
And he's either missed it and you're going to put him out of business, or if you hold him to it, or you're just going to struggle and he's never going to complete. And then you're going to lose 6 months on the project because of delays because he faltered.
Right, right. So taking back, your fund focuses on non-performing mortgage notes. So I guess let's just have the high-level conversation. Chris, I thought Bank of America was the person that held my note. How are you buying these notes? So maybe talk us through what is a non-performer, and then how do you end up being the bank?
Yes. We love answering this question because first thing I'll mention about a non-performing loan, we do also buy performing loans to balance a portfolio, but our specialty is that non, which most people are under the impression that, oh my God, I missed a payment. They called me 3 times. Somebody's going to come knock on my door and like drag me out, kicking and screaming, and foreclose on me. Our average delinquency is 2 to 3 years behind. So these borrowers didn't miss one payment. They didn't miss 2 payments. They missed years of payments on average. So non-performing note is typically greater than 90 days. But for us, we like to see them several years behind. And why banks sell is always another great question. And I always ask the question back to people, have you ever tried to call the bank and get information or dispute like a charge or ask what a charge was or get a copy of something? And people are like, yeah, and stuff. I'm like, how many people did you have to go through and how long did it take you? They're like, oh my God, I had to go through 4 different departments and it took me 45 minutes. Now imagine a bank on a non-performing loan trying to figure out which way is up. And I like to use the analogy of, think of Toyota, and they're running the Camrys down the line. And somebody comes in and says, walks in, some days they shut everything down. I want one car to be specific and custom. They're going to look at you and basically, we don't know what to do. This is nuts. They might have one person that handles it, which banks do. They have people that handle the non-performing, but as more and more start coming in the door, they can't handle them. And here's an example briefly of a loan where we bought it from a bank that the borrower was trying to make a payment, but the bank said, you need to submit a financial application so we can make sure you can afford this. The bank had an internal deadline of the data could not be no more than 90 days old. But what happened is, Matt, you submit the data to me today. By the time it made it's all the way around to people, it already passed 90 days. So by the time it got to the last person, it kept getting rejected. They kept sending the same information. So after the 3rd time they do this, like, this loan's not performing, let's sell it. Well, it's not performing because the person wants to give you money. So there is some challenges within the bank system, but also, and without, we could spend 3 hours talking about the bank system and fractional lending. And if you guys want to just get your mind blown, Google fractional lending and realize banks literally make money out of thin air. Yep. Literally, they can lend money that they do not have. It's crazy. But if it goes in default, now all of a sudden they have to put the money that they don't have into a reserve. So it's actually more cost effective for a bank to sell a loan at 60 or 70 cents on the dollar because of their lending capabilities than it is to try and figure it out or work it out.
Yeah, hold my chocolate chip ice cream, because we could go on a whole tangent about fractional banking and fractional lending. But are most of your non-performers, are they Fannie and Freddie backed, or are they seller finance, or just different types of loans that aren't? Yeah,
they were backed? Typically, we usually don't do a lot of the seller financed ones. And reason being, a lot of those, you got to be careful how they're underwritten and the appraisals on them. A lot of them, I wouldn't say they were securitized with Fannie and Freddie, but it's, credit unions or banks or non-bank lenders who kept them in-house. Some lenders still hold loans, But yeah, there's a good portion of them too that may have been securitized at some point in time. And then once they go in default, they might try and move them off the pools and make their way down. And we are just, for our size, I mean, we're a $30 million fund. The mortgage market's 13 trillion. Defaulted loans is 3 to 500 billion. So I don't even show up unless I'm start looking in a microscope. So for us, when I tell people, yeah, we're buying, 1, 2, 3, 5 million a month, they're like, oh, that's a lot. And I'm like, we see 5 billion a quarter in loans. So there's plenty of opportunity for us from everybody out there in the space.
Yeah, where do you get your tapes from? Are there like discount warehouses out there that have non-performers that they blast out, or do you have relationships? How's that work?
Yeah, it's relationships, but most of it is actually M&A companies. So merger and acquisition companies have a division called whole loan trading. And what they do is they trade all the loans. And the reason why everyone goes to them is because the buyer is the one who pays them a point or a fee. So if I'm a bank, let's say the Bank of Nashville, and I've got a pool of non-performing that's like, okay, we got to get these off our books. They have no clue who buys these things, but they go, oh, well, here's, we're going to go to Rams Trading, who's a whole loan trader, who will put it out to their list, handle all the documentation, transfer all the transfer all the docs. The bank doesn't have to do a thing. And they get the full price because the buyer is the one that pays, 1%, or 1.5% fee. So they don't have to do any of the work or find everybody. So a lot of these larger companies, for example, there's one called Mission Capital, where HUD, Department of Housing and Urban Development, did $500 million pool recently of reverse mortgages. Now they had this company Falcon and this company Mission Capital partnered together and handled the entire process for them. They get a fee from it, but HUD isn't set up to turn around and sell $500 million of loans. So yeah, there's always an intermediary, similar to like the real estate market where there's brokers and you got to go through somebody. It's the same, very similar.
Yeah, and contextualize it like if you've got a $200,000 unpaid balance non-performer, you would definitely take $150,000 versus trying to go chase down that extra $50,000. Like, let's just get it off our books. And back to our point about fractional banking and lending, now I can rewrite that loan at maybe a higher interest rate or go and diversify across multiple loans. So you go out, you acquire this note that is underperforming. It's been underperforming for 2 years, 3 years. Is your goal to rehab that note? Is it to secure the collateral? Like, what's your next steps on that process?
Yeah, our typical exit strategy, like we joke that we fix and flip mortgage notes, but we like to, fix the borrower and try and get them on a repayment plan, get them paying again, and then we quote rehab the borrower in the sense of getting them caught up on payments and getting their credit cleaned up. Then it gives them the ability to refinance. And because we bought it at a discount, they refinance, we get paid that full amount. Or we may turn around and sell that to an investor. And there's lots of investors out there who like to be more passive and buy a performing note that has equity and collect those monthly payments, whether they're using a self-directed IRA, their own cash, or whatever the case may be. Our foreclosure rate is probably less than 10% of our loans right now.
Yeah, gotcha.
And that's our focus is when we look at these loans, we're looking at loans where, okay, the borrower hasn't filed bankruptcy 7 times, the borrower hasn't been deceased for 6 years, or situations where they're either going to put up a really big fight versus trying to work with us, or the only exit is through the property. We always want to try and exit. When I say exit through the property, it means we take it back at foreclosure. We want to try and work with them because I don't want to own the house. I just want my payments.
Right. So we were talking a little bit beforehand. One thing I love about this space is it's just simple math, and I think both of us are kind of a little bit math nerds. If I can extend that gracious compliment to you, but essentially, if you know what the mortgage payment is written at from an interest perspective, you know what the unpaid balance is, and you know how much you want to make, then you can start backwardsing your numbers to say how much would I borrow for this, or how much would I pay for this unpaid balance in this non-performer. However, the real estate market has really shifted over the past 4 years. We went through a catastrophic boom in real estate equity and pricing. And now we're starting to see that kind of step back a little bit in certain markets. So how do you go about, I guess, underwriting or doing your due diligence on an underperforming note when there's so much supply out there and a little bit of uncertainty in the real estate market as a whole?
Yeah, that's a great question. That is probably one of the bigger risks that we're, when we evaluate risk and people ask what keeps you up at night, besides government intervention, it's, trying to place value on these properties, because we also can't knock on the door and see the inside of these, so what they look like. So one of the strategy, I have always been a pessimist, glass is half full. I don't know if that's good or bad, but in the sense of what I've seen over the last 3 or 4 years has been such a big ramp up. I just can't visualize it continuing to ramp up. And one of our key, components in our business plan is we're really not buying significant portfolios of loans that were originated in the last several years. And the reason why is the interest rates are very low, but also I think the properties are, high or at their peak. And I like to focus on loans that are 10 years old, because let's just give an example of a $250,000 home that somebody bought owner occupied. They put 10% down 10 years ago. So, their mortgage balance was 220 and they owe, and the property is 250. Well, a house 250 10 years ago today is worth 400, whatever, pick a number. Where what's their mortgage balance? Could be, even if they're non-performing, maybe it's 200. So they pay it down and values go up. So it creates that loan to value. Our portfolio right now, our loan to value in our portfolio is like 35%. Our investment to value is like 26%. So we're in a business where we don't have leverage, we don't have debt. So we're trying to be as risk averse as possible. So that's another way we stay risk averse, is by keeping that loan to value. And here's a example of what we're talking about offline. We've seen in Southwest Florida recently some non-performing loans come through that, new construction values at one point in time were about, 600,000. Now the properties are sitting at, or people are, non-performing and even trying to sell them at like 475. There's a 20% decline in Southwest Florida. Austin, we're seeing the same thing. Parts of Texas. So you see it in specific markets where, and I think real estate, while it's macro, is really micro in regards to certain markets, will perform better or worse depending on how much of a bump they had over the last few years, because usually the higher it goes up, bigger the drop.
Yep. Do you ever look at certain markets and say, hey, I don't want to be involved in that market because external factors like insurance costs in Florida could inhibit the borrower's ability to pay back, or inhibit my ability to resell that property because of that kind of an external factor?
Yes. So, Chicago, we call it Crook County versus Cook County. Cuyahoga County in Cleveland, all of New York. We typically stay away from, certain parts of Texas, will, shy away from. Interestingly enough, people, and what's interesting with notes is, like we have some loans in California and people are like, wow, you are crazy. And I'll tell someone, I can foreclose 3 times over on somebody in California than I can in Florida, which blows people's mind, because most people hear about, tenant laws in California and Florida. And again, politically, they're very different states. But foreclosing in California is actually very easy. Now, evicting them, that's a whole nother problem. It's the opposite. It takes forever to foreclose in Florida. But once you do, sheriff shows up with his revolver and puts them out. California, you foreclose, but you got to sit there for another year. But I mean, from insurance purposes, we've started to see huge increases in Florida and Texas for insurance, and just everywhere across the country. It's not that we wouldn't buy in those markets, but we are a lot more cautious in making sure that we're anticipating significant increases. So if it's non-performing and we have to put insurance on the property, which is what we do, again, nerd math is we want to make sure garbage in, garbage out, we're putting the right numbers in to make sure we still get the right returns we want.
Yeah, I know. I just have been very hesitant over the past decade, really, of buying anything near a coast, specifically because of insurance premiums. And I
Yep.
definitely don't think that that house will be underwater in the next 5, 10 years. But I
Mhm.
do think 10 years from now, insurance companies will say, hey, I know that house is either going to be underwater or it's going to cost me a fortune to insure it.
Mhm.
And borrower buyers will be deterred. My buyer pool will be smaller if I ever try to go sell it.
Yep. No, 100%. And that's where, we just saw, again, I mentioned earlier, personally, I was looking, several years ago, some property on the Outer Banks, and we just had a tape that, if people are familiar with the Outer Banks, it's a barrier, it's basically a barrier peninsula that has water on both sides. And when storms come through, basically it hits one side and basically everything keeps moving west. But we were looking at a tape, and there was an asset, beautiful home, second row from the water. But, we're looking at it non-performing, and I'm like, this would be cool to own personally, but from an insurance perspective and risk profile for a company, I'm like, this is an awful asset to own because of trying to deal with it. And then, people, someone would buy it, but, the insurance and everything else that's involved in it, your carrying costs just to try before you have to get rid of it are just astronomical.
Yeah, yeah. I want to shift gears and talk a little bit about the overall macro and maybe even micro segments of the real
Mhm.
estate market. When I got involved in real estate in 2015, I had the luxury of living in Nashville. Nashville around that time became a booming city, and so
Yep.
as I was starting to gobble up single family rentals and doing a couple flips and things like that, man, I was
Mhm.
hitting home runs everywhere. I thought this
Yep.
thing was the easiest thing I had ever
Mhm.
done in my life. Over
Mhm.
the past 4 years, I've understood that there's a balance to it.
Mhm.
That real estate is cyclical, just like everything
Yep.
else. Might move a little bit slower, but there are all these other factors like supply, zoning,
Mhm.
interest rate cost, adjustable mortgages, like all these different factors that influence the overall market.
Yep.
So, as we kind of get into the back half of the decade here, I'm
Mhm.
wondering if you could just give us your snapshot view of the real estate market, specifically in kind of the mortgage notes and what you're
Mhm.
seeing. Are you seeing more non-performers,
Mhm.
and the quality of borrower, and just to give us that overall view from your seat?
Hey, fellow investors. Before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
Yeah, let me pull out my crystal ball here. And
Don't worry, it's on the internet, so it'll just be published forever if you're wrong.
yeah, so, and everything on the internet is true. So whatever I'm saying right now,
Will happen.
yeah, it will happen. Um, interesting, on the mortgage side of things, one thing I don't pay attention a lot to is a lot of the reports that get published. And the reason why is a lot of them are either published by real estate associations that have their own self-interest or certain news organizations, both sides, that also have certain interests. I look at the data and what I'm seeing because we're on the front lines of seeing defaults. What I'm seeing right now from a default side of things is a significant uptick in what they now term residential transition loans, which got rebranded from hard money loans because hard money is a bad term to use now. So they're now called RTLs. And when all these companies were giving people 80, 90% of purchase price and 100% of the construction costs who had no experience on what to do, what do you think is going to happen? I've probably seen over the last 60 days, probably about 500 million in defaulted types of those loans, which again is small in the scale of things, but I didn't see any. Go from 0 to 500 million, that's a good amount. The other thing that we've started to see is, and again, there's stats out there that 70% of homeowners live paycheck to paycheck. And a lot of people took out a home equity line during COVID because they had the equity to pay off their credit cards. And after they paid off their credit cards, what's one of the number one problems people have in this country? They have a spending problem. But what did they do? Kept racking up those credit cards. Now, those credit card rates, which may have been 15, 18%, average, I think 28% is what I heard yesterday, the average credit card rate. And now they can't pull that equity. But what are they doing? They're filing bankruptcy. So we're seeing huge swings in bankruptcies now, which don't show up on non-performing loans data because it's a bankruptcy. It's different. So I'm seeing from an economic standpoint over the next, 5 to 6 years, I'm not predicting a 2008 type crash, but I'm also not projecting housing to increase significantly or pricing. I think it's going to soften on several factors. One is I don't think interest rates are really going to come down to where people think they're going to come down. I think they're, probably, might settle back into the fives because nobody else wants to buy U.S. debt right now, which kind of carries bonds and rates. But with that, something's got to give because you're either going to completely eliminate, 1 or 2 generations from ever buying a house in the next 10 or 15 years, the younger generations, because there's no way, based on where salaries are at, that they're going to be able to afford, a type of home in urban areas. So you're either going to exclude all of them or bring them into the mix. But the only way to bring them into mix is either pay them a boatload of money, which last time I checked, companies aren't going to, start just cutting bigger checks for people, or the pricing has to come down. Something has to give, or somebody's going to lose. It's not a net sum zero. So my prediction would be that you will see pricing slowly soften and then kind of flatline. Very similar to, I bought my first house in 2001, and 2001, 2, and 3, they had a little bit. I mean, I was getting 2 to 3% per year, which is probably more norm. I think we might flat 2%, flat down. Little dribs and flows, but you're not going to see 19% or some of this other stuff that we just be seeing lately. Unless the government just goes nuts and starts printing money again. Which who knows, maybe they do, but I think we're going to start to see more of a softening and leveling off.
And obviously all of that is market dependent, right? Like I love Austin. I think we were chatting about it offline.
Yep.
I think that's a market that's going to be hammered for the next couple of years. Nashville's a little bit oversupplied, but I think we can kind of burn through that in the next 2 or 3 years. So it's not going to be as terrible. But if you've got a, what's the Bentonville, Arkansas is a good example of, I don't know if they're building enough supply. So maybe your market's a little bit different. One of the things that I think is interesting to kind of keep an eye on is this idea of how much salary to mortgage payment or rent to income ratios are really panning themselves out. When we were late into 2023, I saw a lot of people pushing multifamily deals that were like, oh, we can raise the rents to market rate rent. And then when you run the analysis, you're like, but that's 40% of rent to income. I don't think that's sustainable for a long enough time period. So I don't know if that's the kind of data that you guys see from a note perspective, like income to payment standpoint. But can you talk a little bit about that?
Yeah, and that's really what it boils. I mean, you can take home prices and interest rates and put them all in the box together. But the other thing people forget about when they put interest rates and home prices for a payment together, we're forgetting about the 2 other big factors: taxes and insurance. And when have you ever seen your property taxes or your insurance payments ever go down? Those areas now are starting to really jump 10, 20% as well. And at the end of the day, all of that, however you make the cake, or take those ingredients and make it, it comes up to a payment. If interest rates go down and pricing goes up, it's like if the payment's $3,000 a month, the payment's $3,000 a month. But now you've got some fixed costs of taxes and insurance that keep creeping in more and more. And that's like a lot of people who are buying rentals realize, oh my God, my rental in Texas went from $2,000 to $4,000 a month in insurance, and my taxes went up by $2,000. So I was cash flowing $200. Now I'm negative cash flow $200. and they probably can't sell that for what they've also now got into it, because people only have so much money to afford on a payment. I mean, if you make, $52,000 a year, you're making $1,000 a week, that's, $4,000 a month. Bank is going to say, okay, you get, call it 40, 30% of that. So it's like, okay, you can afford a $1,200 mortgage payment. And it's like, okay, how I get to 1,200 somewhat irrelevant. That's what I can afford. So previously it may have been a $200,000 home. Today it's like, forget it.
Yep. Yeah, I actually got hit recently with one of those insurance cost adjustments. Fortunately, this is a house I've owned since 2016, and we've almost 50% up on our rent. But like, it was an extra $1,500 a year in insurance, and I'm like, dude, that wipes out one month of rent just on insurance there.
My home that I live in, my primary residence, they wanted to go from, I want to say, from like 3,500 to like 6,500 or some insane number that was just, I mean,
Double.
It was like almost like doubled our insurance. And it was one of those reasons, like, clearly insurance company just didn't want to insure us.
Yeah.
And will you pay it? But I mean, we still searched and went out, but it still went up 20% is the best number we could get. And, it's like, okay, it went up by, $700 and, which, it's $60 a month, but then our tax bill, also went up by about $120 a month. So I just had, a $200 increase in payments. And we also forget about this little other factor that's out there besides homes is, groceries and inflation. And if anyone actually believes inflation's only 3% or increasing at 3% or had gone up by 20% in the last 4 years, go back and check, your Amazon receipt or what you paid at the grocery store 4 years ago to today, gone up a lot more. And again, people who are making $60,000 4 years ago, I bet you they didn't get 20% pay increases every year. So now they're making 100,000. They're probably now making 70 to 75, but they can't keep up.
Yep. I think this insurance piece and the fact that you said it earlier, and I just want to pull it back out and put it to the forefront, is nobody wants to buy U.S. government debt anymore, are the two things that I'm like, if I could say that keep me up at night or I worry about, those are kind of the two things right there.
Yep. No, that's 100% of, and when people, and I'll nerd out a little bit, but when people say, oh, the Fed dropped interest rates, it has nothing to do with mortgage rates.
But the 10-year treasury went up.
Yeah, the 10-year, which is what mortgage rates are based off of, because you have investors, they can buy a 10-year treasury with no risk or a 30-year mortgage, and they'll pay about, I think, 2% for that risk. But if the government goes to sell these bonds at par and they're selling 100 of them, but there's only 50 that people want to buy, then they're going to underbid, which then drops down, which causes rates to go up, because next time around, they have to bump it up to get more people to buy, which causes your mortgage rates to go up.
Yeah. Well, that's why we're building this Bitcoin Federal Reserve, right? Or this Bitcoin Reserve, because if Bitcoin gets to $30 million a coin, actually the U.S. government right now could just wipe off all its debt with the amount of coins we have.
Wow. I did not know that. But in the same token, I think I may have put like $100 in Bitcoin. My whole thing with crypto is, if I don't understand something, I'm not going to invest in it. And I kind of understand it, but also, I'm not a conspiracy theorist, but I'm not a fan of like either political party. I'm independent, and so in some instances, but I also have worked, I'm in DC area, so see a lot of what goes on. If anybody in their right mind thinks the U.S. government will ever let somebody override the U.S. dollar in any way, shape, or form, basically, oh, we're going to have a global currency. And I was talking to a banker the other day, and he mentioned Bitcoin, and the banks he said the problem right now is they just don't know how to regulate it. So they're doing nothing because they can't regulate it. But I said, okay, like if we were on Bitcoin, how would a bank lend money with the fractional reserve we have? He's like, you couldn't. Mm-hmm. And I'm like, well, people think, oh, it's great that you have that, but just realize you can't get credit, you can't get a mortgage, a lot of that would go away. So then what would happen? Again, the rich get a hell of a lot richer, and people, my wife comes from a former Soviet Union, and they really didn't have credit where she's from. And, average salary is 20,000, but still costs 20 grand to get a car. So everything's traded on the black market and stuff like that. But, in that sense, again, there's no credit. So what happens? You're either a have or a have not. There is no in between.
Right. That's all these Austrian economics out there who are preaching this DeFi and all that kind of stuff. I'm like, yeah, that sounds great on paper. But to your point, I mean, there's no fractional lending. That means you either have the money or you don't. And by the way, and that was a crazy stat that I pulled that I heard on a podcast the other day. I don't know if that's true or not. But if Bitcoin goes from $90,000 to $30 million, talk about inflation. I mean, the one thing we learned from 2020 is that the American dream is great, but not all of us can have it at one time. Because if we do, then nobody has it because inflation ticks back up.
Yeah, but here's the question I would ask is if Bitcoin went to 30 million a coin, who's going to buy it?
Right. Right. Well, Chris, I always love talking to you. I think we view the world very similar, and we also like to nerd out a little bit. But I want to switch us now to our last round. We're calling this the 4 toppings. Our first one is, what is your favorite book, or just what is a book you've read recently that's given you a paradigm shift?
Yeah, my favorite book is What Got You Here Won't Get You There. And I'm trying to think of the gentleman who wrote it. It's slipping my mind. But I read that when I was working at W-2 and moving into a more leadership position. And when I was growing within companies, I would grow because of my problem-solving skills and really being able to figure stuff out and work through a lot of issues. What was lacking was my people skills, which some would probably argue still lack. But and as people move up the ladder in life or with relationships or whatever the case may be, it's not what you do, but how you do it and how you approach it and how you communicate that. And that book really talked about, if you constantly, if you're, start working at 22 and, get to 32, if you try to do the same thing for the next 10 years, you're not going to grow. You're going to hit a ceiling because you haven't learned how to move up into that food chain. So that's what I really liked about that book.
Yeah, I like this idea of how you communicate too, because, I was having this conversation with somebody one time who had recently had a baby. And they were like, yeah, I just hate that everything's so nepotism and you have to kiss butt to get ahead. And they soften messages instead. Like, I just want to be told the truth. And I was like, yeah, I get it. By the way, your baby is hideous. And I don't know how you love that thing. And he was like, what are you saying? And I'm like, see, you don't want to hear like the truth sometimes.
No,
that is, his baby was ugly, but
when you're mentioning that, a lot of people think they want to hear the truth.
Correct.
But a lot of people actually don't, because it hurts sometimes. I had somebody, make some comments to me once that were just brutal. And, they're probably, half truths where, yes, some of them absolutely. And some of them, I think they were caught up in the wind of things, like, trying to pour it on a little bit. But, it hurts sometimes. But at the end of the day, if you want to get to a certain point in life, you got to take that criticism and run with it and be like, how can I be better?
Mm-hmm. Yeah. Our second one is, what is the best piece of advice you've ever received?
Trying to think of how to phrase this, but essentially, to get where you want to go, you got to do it. You can have others with you, but you got to rely on yourself. And story I'll share was, 10 plus years ago, when I was working, great, highly paid job. My boss at the time was just buying rentals in San Diego left and right. And he looked at me and he's like, why aren't you buying real estate right now? I'm like, I don't have the time or whatnot. And he joked. He's like, you're going to join the 40-40-40 club where you work 40 years, 40 hours a week for 40% of your payment, your money. And he's like, if you want to get anywhere or, really enjoy the latter part of your life, you got to take the initiative. You got to do it. You can't rely on somebody else. There's no lottery no golden ticket, no lottery ticket, no government agency. Nobody's going to come give you that handout. You got to sit there, grind it out and, do it yourself.
Yeah, I got a lot of comments on that I'll say off air, but yeah, I agree with you. Like no one's coming to save you. So you might as well just take ownership and try to figure it out yourself. That doesn't mean don't collaborate and all that sort of stuff. But if you're waiting for somebody to come save you, chances are they're thinking about saving themselves.
You need support. Yeah, you need a support team with you, but you can't just fly in someone else's coattails.
Yeah. Our third thing is, what are you most proud of in your life?
Oh, my kids. How they, have been raised, and I got to give my wife a ton of credit. But just the respect they show, the care for concern on things. And I have a 13-year-old son and I have a 20-year-old daughter as well. But I can relate, of course, more to being my son when I was 13. And I look at the type of person I was at 13, and, this was, 35 years ago plus. So times were very different where, people would, pick on people and, just, we were, we're just mean and nasty and, trying to get by. And, we did stuff that probably wasn't, the best thing you could do. And, I look at my son today and, he's, just the care, the concern, how he wants to learn, and just his view on life is just so different compared to where mine is. And I think a lot of that comes from, how we brought them up. And so for me, I'd say that's my biggest, reward or, thing that I look at.
I love that. I mean, I was an angel at 13, so it sounds like you were an outlier there, but yeah. And our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
Oh, there's a lot of people. Right now, if I could do it right now, it would be my father and grandfather. My father passed away when he was 68 years old. My grandfather was like 72. So, and my father's 6 years now, and my grandfather passed away in 1997. So that's 3 plus 27 years. And sit down with them and just show how much I've grown. I have my own company now, where like my father never saw me grow into starting my own company or doing my own thing, or share the stories of what I've experienced, at my age of turning 50 next year. So I know a lot of people would probably pick some famous person or whatever case. For me, I'm like, hey, look, it's great that I would love to sit down with Elon or somebody and just, hear all the nerdy stuff he said. But the most inspiring or the most, heartwarming would be, of course, be back with family.
Yeah, I love that. I think one of the things I am very happy I've gotten to experience is to see my parents see me jump into being successful, right? I joke, but when I was 13, I was not the nicest kid in the world, specifically those 13 to 18 years. So to see them come out on the other side of me, come out on the other side of that, they talk about all the time how proud they are. And I always tell them, hey, I'm just at the beginning. You got to stick around.
You stopped at 18? Why'd you turn around at 18? For me, it was about 22 or 3.
Yeah, I gave up on those last 5 years,
Yeah.
Well, Chris, fantastic having you on. Always valuable for me. If our listeners wanted to reach out to you or learn more about you, where's the best place we could point them?
Yep. They can go to our website, which is 7einvestments.com. It's a number 7, the letter E, investments.com. You can reach out to us there. You can email me, chris@7einvestments.com. You can find me on LinkedIn. There's only one other Chris Seveney in the world, and so just look for the better looking one.
And don't go to him.
Yeah, don't go to him.
Yeah. Awesome. Chris, thanks for coming on.
Yeah, Matt, thanks for having me. I really enjoyed it.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.